Um, we'll be going over a lot of stuff throughout the time we talk about this stuff. We'll be going over a lot of different parameters. We're going to ask you guys to raise your hand if you have a specific question or something like that, or put in the chat. What we're going to go over is going to be probably a little bit new to you guys because of where you're at. But it is also very helpful for you guys to understand what the options you have, because what we're talking about are possibilities for you to cash out on deals that you may have already created that you need some capital for to do more stuff. So we'll give it another minute. We're expecting between 30 and 40 people to be on here, so please feel free to be patient for a minute. We're gonna have a lot of questions, I'm presuming. As far as time-wise, we do not know how long this will be. We figured it an hour, but it may go a little longer. We're here to answer questions and make sure that this, for the end of the year into next year, you have the ability to really pump up your systems and create more. If you are brokering notes, I would encourage you to have your originators or sellers join us on our next Wednesday call. If they need something more specific, depending on how this call goes, we may hold this class a few more times. So it would be really, really awesome to have originators who are creating these debts to be on this call. So with that said, we've been 2 minutes. Let me get started here. I'm Dave Putz. I'm from JKP Holdings. I've been buying notes since 2010, where I started a hedge fund and worked there for about 2 years. And then went on my own in 2012 to buy notes, primarily residential, first liens primarily, and we bought directly from bank originated assets. Since then, I've created my own company. We have our Facebook group, and in 2020 years, whatever it was, Nathan joined me, who's a partner of mine on my podcast and webinars. We're partners on it, which we hold every other week with guests from note originating to note buying fields like that. So Nathan, can you share a little bit about yourself, and then we'll introduce Sohail?
Yeah, you bet. So Nathan Turner, I got started in notes in 2008, and I actually got started by originating notes. So I know where you're coming from. I've been there, I've done that. I moved into, I was kind of doing it at the same time, originating some notes and buying non-performing notes so that I could get the property and originate new notes. That's how I kind of got started back in the day when I started buying non-performing. So that's where my background comes from. The latest and greatest for me is that now I have a fund where I'm buying performing notes. So I'm going back to kind of my roots, back to the originators. And I would love to buy more of the seller finance paper. I'm a big fan of it. I understand it. I've done it. So I'm going back to that and looking for that kind of paper these days.
Yeah. So we're here to kind of help you sell your notes. More than that, we're here to help you cash out on deals so you could do more deals.
Yeah.
Basically your private bank. What we're going to have here is we're going to be sharing with you guys how we're going to keep everyone off video because we get me too much. Sohail's here. He's a servicer. For those who don't know what servicers are, what we do in our space, which is a little different from our brick and mortar properties, is we actually have a property manager in our space called a servicer. They do all the typical actions that a property manager does in the brick and mortar rental space, but in the servicing side. They keep us legal, they keep us contained, but they also we work with our borrowers on issues and problems or whatnot. What's a little bit different about Sohail, as I introduce him, is he understands the seller finance world, where a lot of the people in the servicing space don't. It's a different ballpark with you guys when you're originating these debts, because it's not the typical note created by Bank of America or whoever. So Sohail, welcome. Thank you for joining us today. Can you share a little about yourself and what they can expect from a servicer in your role?
So thanks, guys. As a servicer, our responsibility, of course, is to make sure that the payment gets made on time, that the asset is protected with adequate insurance coverage, or if the borrower doesn't have insurance, then we would force place insurance on it to ensure that at no point in time if there are any claims being filed, those get handled with the insurance policies that we put in place. Make sure the investor gets paid on time. And if the borrower tends to default, then jump in very quickly, find remediation methods, loss mitigation methods to ensure that it doesn't get prolonged. Texas, which is where I'm based, is very unique. Once a borrower defaults, you can basically foreclose in 120 days or less. Other states are longer, and so there's a process to follow and ensure that the property is still protected, it's still there. We've had a property disappear because the mobile it was not attached to the land. And at the same time, it's ensuring that all your regulatory filings, all your IRS filings are done correctly, and those tax statements are sent out annually to both the borrower and the lender, and basically keep you in compliance with any potential regulatory actions or issues that could arise. So my job is to basically be your guide, in the sense that not only am I doing the work of collecting the payments and protecting the asset, but ensuring that you don't originate a note that is out of any CFPB regulations or your specific state guidelines as well.
Awesome. Well said, so Al. So I did see a question in the chat. Before we get into finding note buyers, if you're creating notes, originating notes that are not attractive, you can pitch it to every buyer possible. They're just not going to like it. For example, if you're building a house and you put black and red paint everywhere because you love the colors, and you're looking for buyers to buy the house, me showing you where all the buyers are who want houses are that want the normal natural colors, I can show you where all the buyers are, but that may not sell the house because they don't like red and black walls, right? If the buyers are looking for a particular setup, they're not going to buy that asset because of the fact of the way you structured it versus just finding buyers for houses. So you need to structure the note, which we'll go over, in a way that makes it attractive to note buyers. And that's the key, that we'll buy every note you create, right? And we know a lot of note buyers who may not have our buy boxes that could buy your note. But if you're structuring it in a poor way, it doesn't help you at all. Does that make sense, everyone? Hopefully it does.
And it's interesting because everybody's got a different buy box. We're going to talk about kind of generals. And then as you talk to different note investors, one investor is going to prioritize this over that, and somebody else will do vice versa. So we'll show you kind of the general, what it looks like and why it's attractive, so that you have the principles so that you can go out and structure it so that generally it's attractive. And then you're going to find your specific note buyers that have this priority or that priority.
Yep, absolutely. So with that said, we're going to get started here. I guess we can share the screen so people can follow along too, so it doesn't get boring staring at our gorgeous faces. But let's start with here. All right. So as you can see on this document here, we're going to cover a bunch of different areas. We can share this document for view only if you guys would prefer, but we're going to kind of go over it so you guys can see what it looks like. So let me actually move this over here. So I'm actually looking at it. So what you guys, all right. So first we talk about the fact that we want to make sure you're making these notes legal and constructed in a way that is something we can manage if things go bad. Now, if a note never goes bad, how you structure it really doesn't matter, to be honest with you, because if the borrower pays you in full and it never goes bad, the legality part of it doesn't really come into play, right?
Yeah, and we've come from a non-performing note string for the last 15 years. It's just been non-performing notes. So it's nice to say that it'll never not perform, but
Yes.
the reality is people stop paying for all kinds of reasons, not because they're bad people, not because, I don't know, they're trying to screw you or anything like that. It's just life happens. So
Yes.
they do go non-performing, probably more than you would want and probably more than you'd think. So that's number one. We want to make sure it's done correctly so that if it does go bad, as the note holder, we have some kind of recourse.
Yep. Absolutely. That's a big thing here for us, right? Is that we're not saying that you're doing wrong things, find the wrong borrower, but anything can happen to that borrower to cause them to stop paying. So if they stop paying, that's when legal really kicks in. So if you don't do things by the book, that note's basically worthless.
Yeah.
And perhaps, right? So the first we want to touch upon, and people may have heard this thing about Dodd-Frank. Now, in the note originating world, we've heard more and more people say, I don't know what Dodd-Frank means. How does it apply? In a very quick, simple, I think the page is like 20,000 pages, whatever it was, is that if there's a homeowner who lives in a home that has a debt with somebody, they need to be underwritten and arm a load. So if that person lives in the home and borrows debt to buy the house, they need to be fully underwritten and fully arm a load, right? So go ahead.
And to clarify on that, they're because you own the house and then you're allowing them to pay you over time, you're lending them money. I know it doesn't seem like that. You haven't actually come out of pocket, but you are considered a debt collector at that point.
Yes.
Even if you haven't actually written them a check, it's still considered debt collection. They are on a contract to pay you over time. That's what that is. So yes, that does apply to you.
Yeah. And Sohail's here to really kind of answer questions. So he's just going to be in the background. So if we have anything coming up with servicers, that's his role here. So we talk about the RMLO part being essential. What that really means, the fact that the RMLO, there's RMLO, there's underwriting. Underwriting just has the ability to repay, meaning the borrower has enough, the debt to income ratio is enough where they have the ability to pay, they're not underwater in their payments. So if that comes up, then we're worried about the fact that they have the ability to repay. If you don't do RMLO or underwriting and you did a seller finance deal to a non-owner occupied or non-owner occupied property, that's a problem, right? That's a Dodd-Frank issue. And you need to really adjust that. Is there solutions to it? Yes, we can work things out with the borrower as long as the borrower is willing to work with us.
Yeah. And the penalties for not following, if CBB decides to come after you, the penalties for not following are really stiff. And we haven't been able to get a solid answer on that, Dave. We've asked around.
Yep.
And what we know is they're severe enough that you don't want to deal with it.
Yeah.
So, and it's not even necessarily, let's say you've created 10 loans, they look at one and then they say, oh, what about those other 9? So it's not even just a one-time deal. If you've done this over and over again, they can and will look at everything that you've created. So
Yeah.
it is a big deal.
Absolutely. So the second part of this is, what is a non-owner occupant property? What does that mean? Typically that's landlords, right? That means maybe a bridge lending where the borrower is an investor. They're buying the property for an investment of some sort, right? So if the situation is that there's a non-owner occupant, there's some adjustments to be made, right? Now, we have no problem buying either one of them.
Yeah.
As long as you did something to make it legal. Now, if you sat there and didn't do RMLO or underwriting, we're going to have to come in and fix it, which means it costs us time and money, which means we're going to increase our yield to make that up. So with that,
it's not necessarily a deal breaker, but just realize that your note automatically is not worth as much.
Yes.
Again, it's really important that you go through that process. We can go into it here in a little bit, but you can actually have the borrower pay for that so it doesn't come out of your pocket. But it's very important that you go through that process.
If we have to do it, it's going to cost us money.
Yeah.
If you do it, you'll take it off here. So we have to add a 2%. We're going to be talking about what we're going to add and subtracting from these numbers as we go forward here, right? If this thing is owner occupant and we're working on stuff, we can make things happen here, right? So the 2% actually should be down here. I apologize, guys, right?
I'm just actually, I can only see a black screen, Dave.
Oh, I'm sorry. Let me
double check. I don't know about everybody else, but for me, it's not working.
Here. I apologize.
Just want to make sure that's.
Is that better?
Not on my end. There it comes.
There it is.
Yeah.
All right. Good deal. So let's continue here. So what we talk about here is owner occupants like that. Table funding, we're going to talk about in the seasoning section. What table funding means is typically that when you're looking for someone to buy the note as soon as you're closing, that's when we're talking about it, right? So that comes to play with seasoning, where there's no seasoning on the note. That increases what we have that decreases what we can pay for it, because the risk of the person paying the bill increases with situations. Now, not every note investor thinks the way I do. Nathan has a different perspective. And this is what we talk about. Each note buyer is a little different.
Yeah.
Right.
Yeah. I have no problem with table funding. I figure if they're going to stop paying, it won't be in those first 3 months. But that's, again, difference of opinion. And I get it from Dave's perspective. I think they're going to continue paying. So that's the gamble I'm willing to take. But it varies. Some people are going to be more comfortable. Some people are not. So again, you're going to have to find that right note buyer at that point.
Absolutely. Cool. So we're going to keep continuing here. We have talked about the fact that subject to versus wrap. I'd love to see in the chat, if you could put down there, are you typical when you're creating these notes, are you creating a wrap note, or are you strictly self-financing, you own the property? Put in the chat which ones you're doing. As we discuss here, we're going to break down that kind of mentality. Now, if you're creating a wrap note, there's two different wrap notes in our world. The first wrap note we call a third-party borrower. And the third-party borrower means that you, the lender, are not the underlying borrower. You took that maybe you paid someone to move out of their house and you took over their debt. The 3% debt, right? That great 3% debt, you took over that. Versus you took a hard money lend, or you own it outright and you now wrapped it with that underlying debt there, right? So if you borrow money, a hard money lender, or you borrow money from a friend, you bought the house and you owe that money and then you wrap that debt, that's fine with us. The third-party borrower is our problem.
Yep.
So next sentence talks about this, right? We will not buy a third-party borrower without paying off the first lien at all. Zero.
And again, this is one of those things where it's going to differ. Dave and I agree on this, where we both just want to pay off that underlying first. First of all, I like to be in first position. That's the safest place for me to be, and I like that spot. The other issue is what happens again in case of default. I can just see it getting really messy really fast, and that's not something I want to be dealing with. So I want to pay off that underlying first, make sure that that's gone and away, so that that's not a potential issue down the road.
Absolutely.
But we have talked to people where they're okay hanging on to that. And again, if they're willing to take that kind of a risk, that's fine. I'm not even saying it's wrong, but it's just not something I'm willing to do.
Yeah. We understand the fact that math doesn't make sense. We get that.
Yeah.
Why would you buy the wrap and pay off the first? That makes no sense. You lost 3%. I get it. Just understand that we're just not for us.
Yeah.
Okay? Awesome. So we'd love to hear more in the chat, guys. If you're tuning in, you're trying to learn. So please put some questions in the chat or respond to what we're talking about, so we know the fact you're here and you're looking to learn some more. So I see Ken, who came on our webinar a few weeks ago. Ken, appreciate you seeing you too, man. So what we're talking about is the wrap notes and what we will or won't do. Our next section is all about the idea of the type of security. Now, the type of security is important. There are multiple different security types in this situation. The security type means what is the security to the county records, right?
And part of this is dependent on what state you're in, and what they use is that it is a mortgage note state or is it a deed of trust state. And that depends. That's going to be more of a judicial, non-judicial question. Texas, for example, is non-judicial, so you're going to use a deed of trust. Ohio is judicial. That's a mortgage and note. So that's number one. That's one of those things. And then we got land contract and contract for deed, agreement for deed, bond for deed, whatever you call it. We call them contract for deed, just to make it easy.
So, Ange, I see your question regarding the fact of where you find wrap buyers. We're talking about once you create that wrap buyer, it is extremely important how you create that debt. And that's what we're covering today, is that forget find the buyers, because I promise you, if you ever look to recapitalize and cash out to get some money in your pocket, you don't create it this way, find that buyer doesn't work at all. It doesn't work, right? If you have some houses outright, I would definitely tune into our friends at Mark Monroe or Nick Morrow. They'll teach you how to find buyers. However, you can find the buyers all day long. If you create that debt, we can't buy it if you do some of the things that we talk about here. So it's really important. So feel free to ask questions and put some stuff in here. Yes, the type of security is huge, right? So we call contract, I shortened it, should not have, but we're just so used to calling it that. So there's different kinds of deed of trust. Okay. So there's mortgage deed of trust, like you said before, contract for deed and lease option. Each one of them have a different parameter of concerns for us, right? Deed of trust is the strongest instrument out there. We're not worried about it, right? But there are negatives to mortgages deed of trust. You have to foreclose on it in all states, right? They're treated as a document with a borrower. Contract for deed, you could retain the title of the note of the property and create a note, and then that borrower has to work off that contract before they get the deed. And the lease option is very similar to contract for deed. It's a little bit different. They're tenants, but in the kick them out of the house kind of mentality, it's similar. So certain states are allowing contract for deed, certain states don't. So if you are creating contract for deeds or rep, we'd love to hear in the comment section, what are you creating for those buyers? Because that will determine what we do, right? So in our case, if you're creating contract for deed, expect that our yield number will go up 2%, right?
And again, it's a comfort thing as well. Like, again, I'm more comfortable with contracts for deed than Dave is.
Yep.
For all kinds of different reasons, but it's just kind of what you're used to. Like I say, when I was starting and I was doing originations, that's what I was doing, was contracts for deed. So that's part of the reason I'm more comfortable with it, is because I've created them. I'm very comfortable with them. I've done them lots. So we're happy to look at that. That being said, they are different, and you get a different kind of borrower with a contract for deed than you would with a mortgage. And I think that's really what it comes down to with people's comfort level, is really and truly, it's a different kind of borrower. The borrowers for the contracts for deed tend to be more coming from a renter mentality, where maybe they haven't quite learned that they own the house and that everything that they need to do is their responsibility. It's not, I'm not a landlord, I'm your bank, and that's it. And so the bank doesn't fix the roof.
Yeah.
And so if I get a phone call, I say, okay, great. Now what are you going to do? I'll turn it back on them. But that's been my experience with those. So it's a little bit of a different.
We're going to back up for a second. Just some key points here, right? We're going to be talking about 80-20, 70-30s, 100% financing. So if you're creating notes, you may not want to create 100% first. You may want to create 80-20 and 70-30. And we want to show you guys what that means. And that, you want to create a solid deal. Our ideal is the fact our investment to value, or ITV, is not going to be anything over 75%. And that reason is that if we have to foreclose or do any kind of stuff, it protects us in that angle. So one of our calculating numbers is the fact that the ITV is never going to be above 75% of what the value of the property is.
So in other words, you could have property value is 100,000, just for easy numbers, $100,000. The note balance may be 85, and you wrote it at an 11% interest rate. Good for you. We'd pay you no more than 75,000 for that.
Yep. No matter if it's a 15 yielder, we're not going to pay you more than 75% of the ITV.
Right.
Just what we do, because if it defaults, right? Things happen.
If it defaults, if the value all of a sudden drops for some reason, we go through another 2008, whatever. Who knows? If the value drops, we want to make sure that we're well protected in there.
And we'll get into the fact of property value, but one of the key things is we want properties over 50,000. So if you're buying houses and wrapping them, we want to make sure that the value of the property is over 50. There are multiple reasons why we do this, but just be aware that that's what's going on here.
Yeah.
So, now we talked about the fact that borrower paying servicing fees. This is a really awesome way of reducing the cost for the lender, because on a monthly basis, you should be using a servicer. And if you're using a servicer, allowing the borrower to pay servicing fee will allow us to pay more for that loan because we're not having to cash out that $20, $30 depending on the servicer, their fee a month. It helps us out. However, for those who are on the call, you're gonna get a little sneak peek. Hal, it being a servicer, shared the fact that if you are creating a wrap note or a second lien, you cannot create a wrap note and have the borrower pay the servicing fee if the wrap note is above 10%. Does everyone understand that point? That if they're creating a second lien or it's a wrap note, you cannot put into the contract that the borrower pays servicing fees. You're going to find out shortly that all of the notes we want to buy has to be a decent yield or your expected really deep discount.
Yeah.
So if you have questions about that, go ahead, Hal.
So the one thing I will add, that's for the way I understand it, that's limited to Texas only for now.
Well said, yeah.
And the one other, so we were on a strategy session today with a couple of attorneys and came up with an alternative that could actually work in a scenario like this.
Okay.
On wrap notes, I typically see 11%, 11.45, 11.99% right now on wrap transactions. So one of the things that was suggested, which seems to make perfect sense to me, is let's say as an investor, you're creating a wrap note with 11% interest rate, and you were expecting the borrower to pay the $35 servicing fee. Well, in this case, why not just go ahead, because you know that you're limited because the rate is over 10%. You can't charge a servicing fee to the borrower. Why not raise the interest rate by maybe a quarter or a half, and then absorb the servicing fee as cost of doing business for you?
Absolutely.
And yeah,
Good
so
work.
the attorneys actually, one of the attorneys suggested it. To me, it makes perfect sense. I think it's better in a scenario like this where if you were going to charge 11, go with 11 and a quarter or 11 and a half. Now your overall, your net impact to what you were expecting to make on that transaction will not be reduced. It will probably remain the same or maybe even a little bit better. And at some point, if they're looking to sell that note, it still benefits them just as much. It won't impact the quality or how much money they were originally looking to make. It won't get reduced significantly.
That's interesting. So from Dave and I's perspective, I can offer a little bit more because it's a higher interest rate. However, it's not quite as juicy as having the borrower pay for the servicing.
Yeah.
Do you agree, Dave?
Yeah,
Is that how you
because
see that?
if a service fee is $30, right, and that loan's a monthly payment is $300, that's a 10% change, right?
Yeah.
If that payment is say $3,000, it's a 1% change. So it depends on the deal itself, how much impact. If it goes from 10 to 11, it may not be enough juice to offset that number.
But that's an interesting strategy. I mean, higher interest rate is always better, and we're going to get into that. But
yeah,
interesting.
Absolutely. So for those who don't know, this
is a workaround
chart to see why interest rates are better. So a 9.5% written note. If we're looking for 12, understand the fact that we're going to ask 81 and 3/4 of the full value of the UPB on rough estimates, right? And things like that. So cool stuff. So when we move forward here, let me go down to where we were. And then we're going to get into, so as you can see, depending on the deal, our discount will increase our desired yield based on what kind of deal it is. So we encourage you to create mortgage deed trusts. This number here will differ from note investor to note investor. They're going to be out there, people out there say, listen, it doesn't matter to me, right? Just understand the fact that is a factor when you're creating these notes. So Mark asked the question, is it 10% cap before I charge the servicing fee in Texas only? Yes, Mark. Right now, as far as we're aware, that cap is only for Texas. So awesome. Thank you very much for the question. So we dive into here note numbers. This is the crucial part of note. If anyone, I love to hear in the chat how many people out there have heard that notes are bought on a percentage of UPB. If you have, please say something in the chat, because we're gonna blow that up in a second, because it just, and I get why people say that. It is a very quick, yeah, you've heard Nick say it. It is a very quick kind of guide, but it's a wrong feature. And for a quick
just doesn't work.
idea,
Yeah.
so Stephen, to ask you, Steve, I'm not sure what the questions are regarding, so feel free to put some more details in there. Right. So, yes, percentage of UPB takes out all the note numbers. It really doesn't tell me anything. And the reason is if the note's at 2% or note's at 10%, 75 or 80% of UPB are two different numbers, right? Percentage of, oh, thank you, Stephen. So Stephen asked, what is UPB? Great question.
Great question.
I apologize. We're speaking in note terms, right? UPB stands for unpaid principal balance, right? So unpaid principal balance, right? So what that means is the notes was 100,000. You got 3 months of payments. Now you're down to $98,452. Blah blah blah. Setting it flat on a 75% or 80% of UPB is not way note buyer buys notes.
No.
So legal balance, Steve, and I see in the chat, I think you sent me privately. Legal balance is the collected unpaid balance plus any arrears, forced place insurance, whatever is collectible.
Yeah, anything else that's collectible in there. If we had to do legal, that can be wrapped in there as well. Some can, some can't, but any of those kind of numbers, anything extra besides the actual unpaid principal balance, that becomes the total payoff.
So collectible monies can include any kind of back taxes that are paid by us. Depending on the way that the agreements sit in the original contract, it depends. Sometimes I can charge my attorney fees, sometimes I can't, depending on the state, like that. So we never go off either one of these numbers. However, I would encourage people, if you expect to make an offer on notes, that you don't bid at 50% of UPB, because sellers won't excite that, right? What we do bid on is on the note. The note gives us numbers. So the PV in this case is a present value, which is a financial calculation. That's the original balance. That drops down in value when the note's being paid, the principal balance. So this has to do with the principal amount of the note, right? When we talk about this, this is what becomes a UPB, the unpaid principal balance. And then that starts dropping.
So again, that original balance, the original balance of the note maybe was $100,000. Like Dave says, maybe they've paid for 2 years, and for every payment they make, there's a little bit of principal and a lot of interest at the beginning. Yes. And then over time, it becomes a little bit more principal, a little bit less interest. But as that trickles down over a couple of years, it leaves us with the principal balance. So they've making $600 a month payments for the last 2 years, but they've only paid off, $1,000 worth of principal in that time. So that's the number we're looking for, is what's the principal balance. And it's not like a rental. It's not the $600 a month times 24. That's not correct.
Yeah, absolutely. So the next part of our note numbers is the payment. And the payment is literally calculated by all the other terms here. The payment is just a byproduct of what you put in the other numbers. So the payment on a calculator is PMT, right? And this is crucial. This only includes principal and interest. No escrow, right? So when a note buyer asks you what the monthly payment is, you never, ever, ever give a PITI or the escrow amount, because the escrow is not giving me the tax insurance money. He's only going to give the lender their principal and interest payments. Everything else gets held in escrow and gets paid directly to the insurance company or the county or city taxes?
That taxes and insurance number, it's not our money at all. The servicer collects it and they hold it for the purpose of paying off the taxes or insurance, but it's not any money that we're ever going to get. Even if, let's say, so I've had this several times over the years, taxes and insurance, those numbers change all the time. One year it's this amount, next year it's that amount. They'll continue to, well, every year the servicer will reevaluate and say, so taxes went up or went down or whatever, usually up. But I have had it where there's a surplus, where they've actually paid too much into their taxes and insurance escrow portion. So there was an overage of about $2,000. I don't get to keep that money. That's not mine at all. The servicer pays that back to the borrower, the person living in the house. So it's not an advantage to me. It has no effect on my numbers whatsoever. That's just for the borrower. I guess the only effect it would have is that would be included in the borrower's ability to repay. They need to be able to make their principal and insurance or principal and interest payment plus their taxes and insurance. And that's for their ability to repay. But that's the only way that it affects us. We don't get to see that money otherwise.
Absolutely.
I will add something though, if you guys don't mind.
Yeah.
As a servicer, over time we've had scenarios where we had borrowers overpaying to their escrow accounts, and then around December, January, what would happen is, for some reason, like especially Christmas and stuff, Christmas shopping, they would then fall behind on their mortgage. And now in January, we've already paid the taxes, the overages, we've run the escrow analysis, and we have a couple of $1,000 excess, which needs to be sent back to the borrowers. I've had investors and lenders ask me saying, well, can we not apply those monies, the escrow refund, towards the borrower's payment? The answer is a resounding no. It's not your money. I understand that your borrower is behind, but we cannot apply those funds without their permission. So we will typically reach out to the borrower and ask, hey, you're due for your December payment, and there's an escrow refund coming. Are you okay with us doing this? Or would you be open to this idea? And if they've agreed to it, then we'll ask them to send us an email confirming the discussion.
Yeah.
And once we have that confirmation, then we go and apply those funds to their P&I or their full payment for that month that they're due. So we've done that in the past.
That's a great point. I've had that exactly where I'm like, well, they're behind by 3 months. That would cover their 3 months behind, but that's not my decision to make. The borrowers have to say yes.
So the next part here is the term. This is the number of months that a borrower is going to make payments to maturity. Now, does that mean that there's no balloon? That has nothing to do with this, right? You can amortize that through the amortization term, really. Now, you can have a loan amortized over 40 years with a balloon at 5. And that's two different things, right? This determines the monthly payment. That's what helps us do it, right? So this is just kind of be known the fact that when we do this, the lower the term, the higher the monthly payment, which means more we're going to like it, right? So if you can get this down to a 1-year term, the payments are going to go up, but you're going to get us to pay more for the note because the way the numbers work out. We get paid more for a lower term note because we're going to get our money back faster. Time value of money, right? And one of the key things that Nathan had pointed out is that if you can create notes instead of 30-year, not 20-year, but 25, that's a key item. So hopefully you guys get that, understand that. 25 years is a really key feature on this.
It just bumps up the monthly payment just a little bit. And even if it's only, whatever it is, $15, $20, $30 a month, that should be something that the borrower can still cover. However, over time and over 100 different notes, if I'm collecting an extra $25 per note per month, that makes a big difference to me. So that 25 years is, for me, that's the ideal term.
Yep, perfect. So the last one is interest rate. This is another key one, right? If the interest rate it's an annually interest earned kind of situation, you get more money the higher the interest rate is. I'm sure you guys play with calculators. Now, you charge a 4% or a 10%, you're going to see the payment increase. So the term and interest rate are two key items here that make things happen, right? So the higher the interest rate, the higher the payment, which means the more we can pay for it, which means the lower the discount we're going to expect. So if people say discount, what percent of UPB? The discount we can pay for a note depends really on the term and the interest rate. Those two are the key items here. So I'll highlight these again for you guys. And if anyone wants this thing, please let me know and I can send it over to you so you can see it, right? Those are the two key terms that changes what we can pay for it and the discount you can expect.
So you wanted to show your chart again, Dave, because
Yeah.
that's key. That interest rate is a major deal. And
so
like
you can
said,
see here
along with the term.
on it, if you have a 10%, this is based on a $100,000 note, right? And 360 months of payments.
So a
Right.
30-year note.
Yep. I can send this link to you guys so you guys can see it. Let me find my little, here we go. Oops, it makes sense to everyone. Oop. There you go. So this is the chart we show everyone. This gives you a roundabout idea what you can expect from a note buyer if you write a note. This is why you don't create notes at 8% and expect us to buy them.
Yeah.
For a good deal. If we're looking for a 12 or 14%, understand the fact that if we're looking for 10%, we're going to have to buy it at $83,610. This is a percentage of 100 grand. If we want a 16, expect a 54% of a 100%, $100,000 note, a $54,000 purchase price roundabout ballpark. But just get the understand the discount expected. This really clarifies why the discount, why the interest rate changed everything. The higher you go, if you create 11% and we're looking for 14, we're 83. Where if you create a 10 and we're looking for 14, we're at 74. Right? That's a huge deal for everyone to understand. This is why term and the term and the interest rate are huge factors. Okay.
So please keep that in mind when you're creating notes. The higher the better, as long as you're not going and breaking any usury laws. And that's the key. And you'll have to go through with your RMLO to figure that out per state because it's different every state.
Absolutely. So we're going to go move forward here. We'll get back to the 80-20 loans because this matters, right? You may have to create an 80-20 for us to buy it. And we'd love for you guys, while we're talking, start coming up with, no problem. So if you have some situations where have a deal that you got going on here, Sohail's a disconnect a little bit, but if you have a question, we can definitely connect with Sohail later. So I will talk to you soon.
Thanks again.
Thank you.
So if you have deals, I'd love for you guys to start grabbing those deal numbers. We're going to actually plug them in and show you what it looks like in a few minutes. So pull up some deals, some notes you actually own, so we can show you some flybys, right? So a first lien versus second lien also is a big deal, where if we're going to buy a first or second, that changes the rate of what we look for. Where 12%, a first lien, we're going to demand a lower interest return than a second because of the risk level, right? Mm-hmm. Now you can create 80-20, 70-30. What does that mean? Well, an 80-20 loan means that you have most of the time, the first lien is at 80% of the total balance of the note, and the second is 20%. So you have a $100,000 note, $80,000 first, a $20,000 second. Why do you do that? It does sometimes you can charge more interest on the second and make that work, right? Piggyback's what they used to call it.
I recommend I would not do this with a 0 down payment. Still get a down payment because that can't get something for nothing. As my dad
absolutely.
Used to say.
So if we're playing with a situation where you have a $200,000 asset and they put down 10%, they put down 20 grand, right? Now you do a piggyback 80-20 on 180, whatever it is. So you can do that. What that may do is allow you to be able to sell the first lien, a better situation, because that 75% ITV comes into play now, where you don't have to take a huge discount, where if you create 100%, that's a bigger discount because now we have to drop down to 75. Why would a buyer want 80-20 loan? because that's what you're offering them. Remember, guys, this is one thing we forgot to mention. I'm going to promise you that there's order of operations when it comes to you and banks. You're not above the bank. What does that mean? If a borrower qualifies for a bank, they're going to the bank, right? If they don't qualify for the bank, you come and help them save the day. So it's not about, hey, listen, my borrower can't, well, they have nowhere else to go. So remember the fact that you are the only place. So you're creating terms that either make well for you. Now you may say, Dave, I don't want to sell some of my notes to you guys. That's fine. You can create a 5% note. Just know the fact that note buyers are using these parameters to buy their notes. So if you're creating a 5% note to sell a note, the discount would be dramatic, right? The chart you'll see if you go all the way to the bottom, if you create a 5% note and we're looking for 12% yield, 56% roundabout.
Yeah.
Understand that, right? So I enjoy the question, why would a borrower not? But if you're looking to sell the note, you're going to have to work this out. The borrower is going to have. If
Why not let yourself just, why not keep that door open? Maybe you're thinking, well, I'm never going to sell my notes. Well, never's a long time.
Yes.
What if, down the road, we've had people sell their notes for all kinds of reasons, where they want to send their kid to college, or they want to redo the kitchen, or they're just tired of dealing with this note that they've had for the last 10 years. Like there's all kinds of reasons, and just don't sell yourself short and leave
Here's
yourself
another feature.
that possibility.
What if you can take my money and make 300% on it because you just went and bought 5 more assets and you did another wraps? Why not, right? If you can go make 100% or 50% return on the money you're pumping out, and listen, you can sell it to me or Nathan, and you can go do more deals. You want to create a note that can be sellable. Does that make sense, everyone? Hopefully it does.
And the other thing too, Dave, you say you buy some seconds now, right?
Yep.
I don't. But what that means is you can do an 80-20 loan, sell the first to me or Dave in that order, and then hang on to the second. So you still have a little bit of cash flow. So if you've got, let's call it a $600 payment on the first and $150 on the second, why not hang on to that second and collect $150? You're already cashed out. Your return on that $150 is infinite. I know it doesn't sound like a lot of money, but your return is infinite. Yeah. Why not? Why not hang on to that second and just keep collecting?
Yeah, and we'll definitely open up for questions in a few minutes too. If you don't want to put in the chat, we're going to open up to everyone when we go through this, and we'll see how much chart we want to go through. Another thing is you create an 80% note. Maybe you want to hold the 20 forever.
Yep.
Maybe create a 9.9% 80, and you create a 14 or 12% second. You sell the first, you hold the second forever. It's a great way to have some cash flow. Yep. You can also do things such as partial, where you can sell part of the payments. Some note buyers will buy it, some note buyers won't. But what it may do is give you some cash in the door, and you sell 5 years of payments, not the 360, right? And if you have a question about that, we can definitely get more in tune with that stuff. So this does not change our price.
Right.
The fact that this does not change our price, if you create 100% or so Mark, I see you shout out to me directly. So Mark may want to make that to everyone, but that's okay. Nathan, I would like to understand the second topic more. I assume this is second charge, second lien, 80% LTV on the first, then you lend more to create the second. I'm not sure if I fully understand the question, but
that sounds more like a HELOC.
Yes.
That's not what we're talking about. However, that is a different thing. This is where so let's say I have a house. Again, we'll go with 100,000 because easy numbers. I want to sell it. I'll take a 10% down payment. So now I've got $10,000 in the door. Great. And then now I'm going to split that remaining 90,000. So I'm going to do a first for, again, this is an exact, but we'll just make it easy. We'll make a first of $80,000 and a second for 10,000. So they're two different instruments, two different liens. You're going to sell off that first to me or Dave in that order. And then you're going to hang on to the second or sell the second if you want. But that second tends to be on a higher interest rate. So why would a buyer do that? Why would the borrower buying the house, why would they agree to a first and a second? What do you think, Dave?
Because no options.
Yeah.
Sometimes there's just no options. They need a
Yeah.
house, right?
It's
And
just
that's the
say,
best option they have,
this is what it is.
right? They
This is
would
what we're
love to get
doing.
a
This is how we're
5%
splitting it.
note, but you're charging 9.
Yeah.
Why would a borrower take 9? Because they can't go to the bank.
Like, yeah. We have also, sometimes it's not even necessarily they can't with the bank, is that they don't want to. We get that all the time with people from,
Yes.
especially from South America, South and Central America. They come up to the United States, they want to buy a house. They don't want to deal with banks because in their country, banks are completely untrustworthy and they are just done with dealing with banks. And I've got a guy who's creating notes in San Antonio and he charges 11 to an 11.5% interest rate because he can, because the borrowers are more than happy to pay that because they don't want to deal with the bank. And it's not even because they can't necessarily, they just don't want to.
Yeah.
So they're happy to pay more.
Well said. So I encourage you guys, if you guys are liking this, we have our second session next Wednesday at 7 o'clock. We're going to go over the same material, but we definitely encourage you to share with other people and, feel free to rejoin us. Let's continue here, right? So when we talk about these stuff, this is all for the note buying perspective. So if you're buying notes, you're probably going, this is boring, right? But if you're originating it, this is a huge deal. But this 80-20, 70-30 may help on the ITV, LTV feature here because we're going to sit there and say, listen, we're not going to pay more than 75% ITV because of the fact that if you default or the borrower defaults, we're covered. So let's go here. So this doesn't change our pricing, remember, right? You can create 100% first, 80% second, 80% first, a 20% second, 70-30, or if you can pull it off and the borrower is able to afford it, 50-50. Right? That's an awesome situation. So ITV versus LTV. ITV means investment to value, meaning if I'm going to buy an asset and the balance today is 80,000, right? My purchase price is 75. My investment to value is 75,000 out of 100 or 75%. Loan to value, that 80% note on a $100,000 property, that's 80% loan to value. So awesome. No problem. So now, again, if a borrower can afford it, you can flip these numbers over where it's a 20/80. I've never seen it, but it can be done. It depends on what order you record in the county records. So the next topic is value and location. What does this mean? Well, this comes to play. This will be a make or break or a percentage drop. Understand the fact that this is what Nathan taught before, that if you're creating assets in certain states that require a debt license, even though you may not get money or give out money, you're still a debt collector because you're collecting on an IOU, a note. Besides needing an RMLO, which is what you need to originate debt on an owner-occupied property, you need to understand that there's debt licenses required in certain states. Okay. In these certain states, if you sit there and create debt on that states, you need to go get licensed as a debt collector. There's a bond and sometimes a fee on paying on the state. So you got to make sure you do that kind of stuff. What are the minimum requirements that an RMLO should require a borrower to make the note sellable? So we're going over some of these things, right? So when you sit there and say, what are the requirements? It depends on the situation. Right? Depends what can the borrower afford. So if you're telling the RMLO, here's what we need, well, you're going to be able to play with some numbers and say, okay, now we're giving rounded numbers. We're starting with a yield number that's kind of high just because we want to give you some plain numbers, right? That they're pretty much, if you can get to this number, you can sell to almost any note buyer. Not that you'd want to because we're the people you want to buy notes or sell notes to, but if you want to go outside the spectrum, there's plenty of people. They're not what our numbers are, but our calculator kind of shows this kind of thing. So
one thing is the RMLO is going to look at, as far as the underwriting process, they're going to look a lot at they call it DTI, debt to income ratio. And again, that's going to vary somewhat, but roughly between 30 and 40. So if they make, we won't try to put numbers on that, but anyway, we'll just say about 30 to 40% debt to income. So they have to have a high enough income to be able to support the debt they're taking on. That's the idea behind that.
This is only for owner occupant properties.
Right.
Landlord situation where the borrower is a landlord, that none of this matters.
Yeah.
Okay. So hopefully it helps you. I'm presuming that's Smitty, right? So when we talk about this stuff, this kind of stuff matters, right? This part here only affects foreclosure exits. Why does that matter? Property value and location is key for foreclosure. Each state has a foreclosure timeline and cost. And every state's exactly the same for timeline nor costs. Each state has different rules, but also different parameters.
Yeah.
Some states have court involvement, some states don't. Even the ones with not having court involvement, different timelines, different costs. So what we look for is the fact that our value of property, we have a minimum of $50,000 property value. I can go up to $300,000 property value. Nathan can go up to $200,000 property value. This does not mean that we don't have enough capital to buy it. This means that we don't want properties with a $500,000 to $1 million balance of value of property.
Right. It's a different kind of borrower. It's a different kind of it's a different animal. It's just not something that I'm willing to take on.
Yep.
Like that.
Absolutely. The borrower changes, the property changes. There's a lot of features that change on that fashion.
Yeah.
Right. And certain states have different taxes. Property tax in New Jersey is really high. We have to take that into account as well. Where Texas is attractive. So most of you guys are doing Texas. That's a great state for foreclosure, right?
Alabama's really low taxes, for example. I like Alabama. It's good. So it depends on where you're at.
Absolutely. So when we talk about this stuff, I just realized one thing I want to add to our calculator that for people to be using is so when the value of the property, okay. So when we talk about this stuff, a property with $100,000 plus value is the most attractive one for us.
Yeah. Right.
Means that we're going to discount it less. If the property between 50 and 100, that's better. We can deal with that, right? Our decrease is very minimum there, if at all. If the property is under 50,000, we are not in shit. It's a make or break, right? So this is a no-go. Okay. We make note that a $50,000 property value and $1 million property value have the same foreclosure costs, servicing fees, and everything else.
Yeah. So it just doesn't make sense with the numbers. So less than 50,000, your monthly payment is going to be something like $300 a month. That servicing fee is a flat fee. It's not a percentage of the payment. So the ratio just doesn't make sense. If we're paying $30 on a $300 payment, that's too big of a bite. So it just doesn't make sense.
Absolutely. So the next one here is the fact that down payment is to make or break. We need to make sure the borrower has skin in the game, 10% minimum. Okay. Seasoning. What does seasoning mean? Seasoning means how many payments the borrower's made. Quick and easy. The borrower just got the loan and made one payment, 1 month of seasoning. Absolutely, Angie, yes. So 1 month of seasoning. Now, if that borrower is making 3 payments, the terms are changing, right? So 0 seasoning months, typically, for me, I want to see at least 3 months, right? I want to see that. For Nathan, he's okay with it. There's no change for him.
I'm good with fresh
me,
cut.
The seasoning comes and goes for me. Because the fact that I want to make sure not only the borrower have the ability to repay, they actually do. So I at times will increase it if it's less than 3 months of payments.
And my theory is they're excited. They're new. It's all fun and exciting. They're going to make sure they're making those payments anyway. So I figure if they're going to default, it's going to be after those 3 months. So who's right, who's wrong? It doesn't matter. Just a preference thing.
Yep, absolutely. So Angie, we did collect it in the registration, but we're going to open up for questions in just a few minutes and show our calculator well for you guys to look at. So I see we have type of property. This is another big one. This is a make or break. If you are creating notes I'd love to see in the chat, which one of these categories are you creating notes on? Land, mobile homes, residential or commercial? And we'll say manufactured homes is a residential, not a
Yeah.
mobile home, okay?
Yeah.
So residential, awesome. Make or break, we are not buying land notes this time,
Not right now.
right? We are not buying mobile homes,
Not right now.
right? These are really a car versus actual property.
Yeah.
Residential, yes. We prefer single families and we will buy some commercial. And again, this is for all note buyers most of the time. Most note buyers are not buying land or mobile homes. They're just not. They will buy some mixed use commercials. Don't expect them to buy, you know, a strip mall kind of thing. But if it's a mixed use apartment slash, you know, restaurant kind of thing, you probably can get it bought for a note buyer.
There are definitely buyers out there for, large commercial. Absolutely. There's definitely buyers out there for that.
So
Not me though.
next thing we talk about is LTV, loan to value versus collective loan to value. Collective loan to value applies to second lien situation. When there's a $80,000 first and a $20,000 second, the CLTV is 100% of a $100,000 property, right? LTV is just loan to value. If you only have a first lien on 100,000, that's 80% LTV. If you have an 80 and a 20 and a $100,000 property, it's 100% loan to value on the second. The first is still 80%. If you have questions, let me know. So we're focusing on the ITV versus the LTV, right? We want to know what our purchase is versus what the LTV is. And we're creating this for the fact you guys can go out, create notes in the image of what we want to buy at. So, and it's a guide for you guys, right? So the next step is, we talked about the first, if there is a second lien, we want to make sure that we know what the balance of the first is and what the status of the first is. That's a huge thing for us, right? If the first is non-performing, that changes what we do. And if we need to know the balance of first, so we can figure out the actual CLTV. Because in the second position, that first position may, if the CLTV is 120%, our second may have no coverage at all, and that's concerning. Hopefully they made sense, right?
And like we've got on here, for me, if I was buying a second, it's because I'm buying the first and the second.
Yes.
Personally, I'm not just going to buy a second by itself. But I would buy a first and a second. I have in the past. I'll do it again.
I'll put this in performing.
Yeah.
And it's not the legal balance, it's the unpaid balance, unpaid
Right.
principal balance. Okay. Hopefully this isn't too much for everyone. I think it's been awesome. We'll keep going here. We're gonna open for questions just a minute as we get to the bottom of this and go from there. So monthly payment, this is a make or break for us, right? If the borrower is paying servicing fees, we don't care what the monthly payment is.
Right.
If the lender, us, the note owner, the lender is paying servicing fees, the monthly payment has to be above $300 a month.
Yeah.
Right. If the borrower's paying, we don't care. It could be $100. We don't care. It's just the fact that our monthly payment, and the reason is it subtracts from what our monthly income is going to be from that note. A $30 fee on $300 is 10%. Means we only get 90% of that P&I, which can throw things off. It just doesn't work well. I would be really careful worrying about usury laws. This is just, each state has their own kind of laws on what I would encourage you to speak to your local RMLO, but each state has a charge of interest of what this is and where we're going for that. So.
Just something to be aware of. Make sure that you know what it is in whatever state you're working in, so you don't break those rules, because that can be trouble.
So, so some key points here is we're never buying on percentage UPB or BPO ever, never ever, right? We can give you a number based on that, but it's not what we're bidding on. We're bidding on IRR and yield.
Yeah.
I would encourage you to have the borrower to pay servicing fees. The higher the interest rate is better. The lower the term is better. Property value over 50,000. Be careful of debt license states. If you're creating notes in Kentucky or whatever, make sure, because you may limit some note buyers from that pool.
Mhm.
You need to make sure you have more than one page document. Do not come to us with a one-page mortgage or note or
Something that you
deed or
wrote on the
whatever.
back of a napkin, that's not going to cut it. It's got to
Yes.
be an actual legal document prepared by somebody that knows what they're doing.
Yes. Owner occupant. You must have underwriting. You must show the fact that you had an RMLO and underwriter completed. Our minimum, or it should be our maximum actually. Our maximum is 70% investment to value of BPO.
That's the broker's price opinion. Yeah.
I got uncheated property value.
Property value. Yeah, that's better.
Right. So now you can create a solid deal. Make sure your deals are, higher interest rates. We're going to target 14%. Now, I'm not saying every note buyer will want 14, but to kind of good number, that's where you'll be able to figure out your discount, right? At 14, if you create 12, you can see the discount. And you can use our chart to figure that out. Now, another one we talked about, I think we missed it, I apologize, is population.
Okay.
We want to make sure that the population of the area for the property you're doing is at least, the city is at least 20,000. Some people do 15, but make sure it's not 3. Okay. Or you're just outside of a large city where the county population is 100,000. That works for us too. If the lender's paying servicing fees, make sure the monthly payment is more than 300. We will not buy third-party borrower, you're doing a wrap, without paying the first off, even if the math makes sense, right? The key here is to find deals with equity. If you have a scenario where you have a property that you're into it for $100,000, you create a wrap, and you now sold it to an end borrower for $150,000, that works in our world, right? You're already in a really good position. Now you create a 70-30 loan, and you're going to look to sell that $70,000 or 70% first of the 150 to us, and that deal will work out all day long. 80-20, 90-30, 90-10. Now, just realize that if you can find equity, that's the key here.
Yeah.
What changes pricing we covered before is the owner occupant stuff, security type, what note numbers, seasoning, and 80-20 notes. Those will change your pricing, right? What will make or break is our monthly payment. If it's a wrap, we will not, unless we can pay off the first lien of that first lien, we're not doing it. Property types that make or break, down payment, and LTV, CLTV kind of thing, right?
Yeah.
What doesn't change our price is how you structure it. We don't care how you structure it, but understand the fact that it's going to change. We're bid it at our ITV, LTV, and what both is property value. So a little comment about the servicing thing. So I'm going to open up for some, I'm going to open up for mics to be unmuted here, so that people who want to talk or ask questions, feel free to jump in here as I bring up our calculator to kind of help guide through those who are curious about it or whatnot. So I'm also in the process. I'll share the link for this Google Sheet or Google Doc in a chat. So, Mark, I see your mic moving. You have a question, my man? No. Okay.
I have a stupid question, actually.
I love it.
If I want to just try and source notes and sell to intelligent people like yourselves, that's a completely different discussion, I'm assuming, because you get inundated with these emails from these characters that will give you $5,000 to go find me some notes and everything else. Do I basically just put my wholesale hat on and go find single family homes within those price points and the geological areas, that the distances that you factor in?
Yeah.
And then I basically have to get one of you guys at the table to do the note, seller finance note piece, and they do the buyer for the other portion. Or is there a way to kind of be a wholesaler of finding the notes, and you just toss it on to you guys, or what's the most efficient way?
There always work, right? I'm going to tell you, you know, the word wholesaling notes is a great term and people love to try getting into it. It's not as easy as it looks. Why? I'll give you a quick story. We actually, back in the day, I sent my tape out from when I worked for the hedge fund, and someone came to me and says, "Hey, listen, I'm looking to buy this note," and I said, "Fine." So they came up with a price, right? They were actually trying to resell me my own assets. That's what it was. They were selling me my assets. They sent me a tape of assets, call themselves their direct to seller, blah, blah, blah. What I did in turn is I actually made an offer on one of them just to find out the chain of broker, or we call it, you know, joker brokers, right? Broker chain. And kind of find out, you can see who was it. So what happened was that end buyer who wanted to make an offer or that came to me wasn't a seller at all, right? They had sent me a tape to buy from them. Well, they got it from someone else who got from someone else who got from someone else. And then a day, I made an offer on my own asset just to see where it went. And there's the point of problems with brokering notes. You don't know who the true seller is a lot of times or the true buyer. If you send it to me and I send it to Nathan, he sends it to someone else, who's the buyer here? And by the time it gets to me, I don't know if it's really, you know, for sale or the seller actually gave you permission. Most sellers don't allow brokering because of the fact that there's a piece of the note that's confidential. These are borrower's data. So if you're sharing that borrower data with someone like myself and I didn't sign disclosure, that's a problem. So brokering notes or wholesaling notes can be real dangerous. And what most people do is they just send out a tape to me and go, "Hey, I got a tape of assets. Can you make an offer?" You just pass along the asset tape. And I really don't want that. I'd rather you, "Hey, I have a list of assets. I analyzed it. I don't have enough cash to make 3 purchases. I got 3 bids accepted, but this 2 I just don't have the cash for. I didn't expect all 3. Here's some BPOs. Here's some numbers." And you analyzed it. I have no problem making help you out there as long as we can truly connect the dots. That makes sense?
It's all about creating my own notes. Because I mean, right now I'm focused more on the land side of things, and I appreciate you guys have nothing to do with the land seller notes, but there's sort of other pockets of communities that like those, so that's one thing. So it basically I'd have to switch my focus a bit from land to doing single family home and using my VA to then go and find owners of those single family homes that are looking to sell. And then we put a decent offer in front of them. If they bite on it, we get them under contract. And then I have to buy the house, or I then have to sell that contract on to somebody else, I guess.
Yes.
Yep.
Absolutely. Yeah. I would, again, we're not in the space of creating notes with that. I'm doing it, but it's not my bread and butter. My bread and butter is buying notes.
Yeah.
We're just trying to help you. How do you structure that note that makes sense for you that you can sell to us if you choose to?
Correct.
Right? Don't create 5% notes. We're going to show you.
No, I'm just figuring. I want to take a step back. How can I create notes to then sell to you guys? But
yes, and that's the idea thing. If you can create 3 notes a month and it fits in our parameters, you can find the borrowers to do it. You can cash flow and sell each note you make with Nathan at the spot at the table.
Yep.
Right. That's key. So
Sure.
absolutely. So
Absolutely.
Great question. We're going to go right to the Catholic. Did anyone else have any questions before I bring up? Go ahead, Vance.
I do too, actually. But yeah.
Thanks. Got a question. Yeah.
Oh.
Hey everybody. Thanks for hosting a great webinar. So I have I have about 20 properties or so, but 2 that I want to sell notes to you guys for. One I just closed on yesterday in Arlington, Texas.
Yeah.
It's a sub-2 deal at like I don't know, 3 or 4%, and then I'm gonna try to find a buyer at like, I don't know, 9% or so. Once I do that and do the RMLO and get the note, can then I give that to you guys, or is there any like specific instruction if I have the address and everything? So that's one scenario. Another scenario, I own some houses outright as well. Some of them I'm wanting to like instead of doing Section 8, I would like to find a wrap buyer and also create a note and sell it as well. I know that the position's a little different, but still, like,
We'd rather the second position than the first, right? We
Right.
rather, because the fact that there's no third party borrower, all
Yeah.
those methods out there where the wrap borrower, you created a note, you actually took over a note, right? And this borrower, Mr. and Mrs. Smith, has been paid off or pushed away, and you're taking their 3% debt over. It gets messy. So all those deals where you are now you did it in trust or whatever, and you're wrapping the debt in that position, in most note buyers' position, they're gonna pay off that line first.
And then just point of clarification for the other ones where you own them outright. If you're selling it on terms, like that's creating a note. So that's not a wrap note at that point because you own the property.
Okay, so that would be a first position lien, which will create a first, a note that I could sell. The second type is just that I used to do an MLO to, in case, let's say the person, my wrap buyer defaults and then it goes to foreclosure. If it forecloses, then the first position note may go away, and then that my note be for first position, I think, is what I get. But yeah. Should we clarify that? I know
So you're saying your wrap borrower defaults? Is that what you're saying?
Let's say like he defaults, he stops paying, and then it goes to foreclosure. Doesn't that then my underlying mortgage with, like, I'll say this, it's A to B and B to C. I'm B, the person that's borrowing to, like, the person I bought it for is A, right? And the person I sell is C. So if C defaults, because I've done an RMLO and I created a note, then even if it goes through foreclosure, like, because like A and B will be gone if it forecloses, then my B to C note will be in first position, which I could sell to.
This is where it gets messy, because your C borrower defaulted. That means you are now responsible for paying that underlying first.
It's like a rental property.
Yeah.
So I will be responsible for the A to B note, you're saying, right?
Yes.
Right.
But if there's a due on sale clause, because if it goes to due on sale clause because of foreclosure, I've heard from Nick and other people that I could then, that's why I do our RMLO to protect myself from that.
The RMLO doesn't protect that part at all.
No, you're still responsible for that underlying first. So you can foreclose on that defaulted borrower, the C borrower, that's fine. But all the while you have to keep up that first that's still out there. If you default on that first, then they'll foreclose on you.
It's like a rental property.
It gets even messier because they're actually going to foreclose on the original borrower.
Yes.
So this is why Dave and I were like, this can get really messy really fast.
So this is like a rental property. Think of a rental property. If a tenant stops paying, right, and you evict them, how does the mortgage payment per month happen with that debt, right? You took out a bank loan and you put a renter in there. You got to keep making your mortgage payment. Even though you're evicting the one person, you got to keep making that payment, right? If you don't, then they foreclose on you.
But like I say, it's even messier because they're not foreclosing on you. They're foreclosing on the person that you took over the payments for.
Right. But I thought Nick said the reason why you do our ML and do a note creation from B to C in this case is that it protects you from due on sale clause.
No.
To foreclosure somehow. But
that due on sale does not go away.
No.
It doesn't go away, but I thought the note creation and note sale could recoup the funds to pay for that due on sale. You know what I mean?
So the C borrower, from their payments, that helps you pay the first, the A.
Yeah, like because they defaulted, let's say the bank finds out and they do on sale clause from from A to B, like for me.
Yeah.
Because it's being foreclosed, that first lien is gone now. So my B to C.
No. If the due on sale clause steps up, they're asking you for the entire amount due on that loan. If you have a balance of $130,000 and you wrap it with a $200,000 note, and that $200,000 borrower defaulted, and a due on sale gets triggered, that bank's going to say, "I need my $132,000 now," or foreclosing.
Okay, from me, basically.
Due on sale states the fact that the money is due now if you sold the house.
But it's actually, and and they're gonna demand that again, not from you, but for whoever you took over
From
the payments
A,
for.
right? But
Yeah.
the house is gone, kind of. The asset is gone. Okay.
So that gets really messy really fast. You agreed with whoever you took over those payments for that you were going to keep it up. So if all of a sudden now you're in default, messy.
I don't get it. I just thought because if C defaults, that somehow because it's going through foreclosure, it would trigger it possibly from.
It can trigger it, 100%. It can trigger the due
Yeah.
and sale clause. Anything can trigger a due and sale clause. But the problem with due and sale clause means that the bank has now said, we want our money now. It's similar
From
to
A,
if you took
yeah.
a mortgage right now and stopped paying the bank, they're going to demand all their money right now.
Is there any solutions from this from the outside?
No, it's a
No,
legal
okay.
situation. I would
That's-
talk to the
that's-
attorney about it, but yeah, if you have a due and sale clause, there are some options that attorneys have tried, but I would highly suggest that just be careful doing. This is why wrap notes become problematic, especially with
Okay.
third-party borrower. We're going to pay off the underlying debt to avoid all those problems.
Yeah.
If the numbers work out.
Interesting. All right.
So that $130,000 unpaid or the under 130,000 underlying, maybe I'm buying that note from you for 150. So 130 of that goes to the underlying first. You get to keep the other 20.
Okay.
That makes sense?
Yeah.
Okay.
Thanks, guys.
Vance, I think you had a question as well, is that correct?
Smitty, what
Yes,
do you got?
I have a similar situation question that you just heard. So I have a property I just acquired. The loan amount is $75,000 currently. It's a single family home in Calumet Park, Illinois.
Yeah.
The ARV is approximately $200,000. My
Okay.
wish list is as follows. I would like to sell it to someone, seller financing, and let it fit the matrix that you all just discussed. That was my question. I was trying to quote unquote, but you can talk better, you can type. So
Yeah.
I need to know what are the requirements that you're looking for me to sell it to Jane or John Doe,
Yeah.
and it's beneficial for all parties. So of course I need to pay off my $75,000 first lien position to the hard money lender. There's no second, third, fourth.
So
There's
pause
nothing
that for a
else.
second. If you have a hard money lender, that means you're the borrower of that underlying debt, correct?
That is correct.
We don't need to pay that off.
Right. So that's not a. Mm,
Yes, you
not
do,
quite
because
the same as a wrap.
it's a 12-month note. So I would rather pay that off.
Okay.
Yes,
Okay.
it's a 12-month note. It's not a fully amortized. So we do want to pay them off.
Yeah. So this
So-
isn't quite a wrap because you're the borrower. With a wrap,
Mm.
somebody else is the borrower on that first that you've
Well,
taken over payments for.
So that's why I'm looking for a little guidance, so to speak. So
Yeah.
in my mind, with these numbers, is ARV is 200. You're going to buy it at the 75%. So that's 150. I owe 75. So give or take $1 I have $75,000 worth of equity in the property, closing costs, fees, and all that, et cetera, et cetera. I can get a check approximately for 65,000, 60,000. I don't care. But I only want to sell a partial.
Now,
Now,
here's
when you're
the
selling a
other
partial-
wrinkle.
Yes.
So two things.
Wait a minute, one more time, because both of you are talking. So what are you
Yeah,
saying?
no,
Yeah,
go ahead, Nathan.
I'll let Dave talk about the partial. I'll talk about the other piece. Two wrinkles. So number one, it's in Illinois.
Dang,
In Calumet.
I knew it.
No, again, is that Cook County?
Yeah.
Yes, it is.
Ooh, that's even
There's a
worse.
nickname called Crook County. I hope.
Yeah.
Yes. Unfortunately, so I am cleaning house right now. So I am getting
Yeah.
the rest of my little properties out of Crook County, and I'm going to shop other places, and I'm going to go across the border to Indiana.
Okay, perfect. Yeah, that's
Good
great.
idea.
Just know the fact that in the whole state of Illinois, a debt license is required. So if you go to foreclose on it, you're kind of stuck. You literally
Yes,
should be. Yeah.
So therefore, it's not as advantageous for you to buy it.
Yes.
Right.
And most note buyers are not licensed in Illinois. They're just not because of Cook County being the way it is. It's not worth them spend the money for the bond and everything else to get the deed. Like Georgia is much easier, right? I'd rather get my license in Georgia versus Illinois if I'm comparing the two, because Georgia is much more attractive for foreclosure and things like that. Kentucky's a $4,000 a year bond. So you have enough income to pay that debt bond.
Correct.
right?
Well, I will still need some assistance in structuring this because I still want
Sure.
to liquidate this because collecting the rent is fine, but I would rather sell it to a investor so they can get the cash flow and I can just take some lunch money and then I will get the back end, sell a few payments, and I'll get the back end later.
So just curious, what would be if you were to rent it, what would be the rental payment?
Oh, it's $1,650.
$1,650.
And the taxes are, I want to say 42, or they're not $5,000.
Okay.
Right.
And then this is another one I'm not trying to take over. I have some assets that are outperforming the note, but again, I'm a professional babysitter. I literally own a property, $100,000 mortgage, and I get $3,600 a month rent.
Oh, that's good.
It's a 3-unit. So that's one I would not give
Yeah,
to you.
no, that makes sense.
So we're gonna go over some
So in
numbers.
that case, I would keep it.
So we'll go over some numbers here, right? So ideas. We haven't put together a formality of what exactly to build into it. It's just difficult because there's so many parameters that depends, right? So let's take the one asset. Give me an asset that you have, and if anyone else has an asset, that we can play with here, feel free to jump in here and give some information. So let's start with this. So we'll show you a parameter. Now these are flexible, and the fact that these numbers will change depend on the note buyer, but we want to give you kind of a ballpark understanding. So
Want to take his deal, Dave? Let's pretend it's not in Illinois, and
Yep.
let's just for numbers' sake.
Yeah, give me some numbers in it. We're gonna skip the Illinois part. So we're gonna say the population.
You want the 3-unit or the single family? Which one you want, the single family or the 3-unit?
Single.
Single.
All right, single family. All right, let's go.
What'd you sell it for? Or what was the
185,
property value?
190.
What was the property value?
200.
Okay, and then what'd you sell for?
I will sell it for 185, 190.
And would you get $10,000 or 10% down?
I will request 15% down.
Okay, so we're gonna do. All right, and you have a borrow occupied, right?
Yes.
Okay. So we need RMLO. So we're gonna say, yes, you got RMLO, right? And it's a wrap note. Are you the underlying borrower? Or it is a wrap note, right?
Well, he owes
It's
some
a short
of
term.
it,
No, so the answer is going to be no, because remember we have to pay it off within 12 months, and we have 11 more months to go now.
He's not
So
a
the
third
answer's no.
party borrower.
So
He's,
we're gonna say yes, and I'll show you why in a second here. So, and you're the lender borrower. What's the balance of the underlying debt that you owe your hard money lender?
Approximately $72,000, somewhere in that window.
High five. Good job on that one. All right.
Oh, I have a couple of those like that right now, but they're in Cook
That's
County.
sweet. I know that's the problem. Could we just move it? Just move the house, So we're good here. We have
so
a
far the
lender
numbers
borrower
are looking really
situation.
good.
We have an underlying debt of 73,000, but we don't need to pay it off in our parameter here, right? 0. So what kind of, is it a deed of trust, contract for deed, or what?
It's a mortgage note.
Okay, perfect. And it's first lien? Obviously it is.
Yes.
Is it payments only? No. It's interest payments. Who pays
Yes.
servicing fees? Who's your servicer?
Well, in this case, I do, because I'm the lender. They're holding their own paper, so
Do you service it yourself?
no, they're doing it themselves. The lender's servicing their own paper. I'm just paying it back directly.
Correct.
money
But
lender,
you're
there's
a
no in
new
between.
borrower. The note you're
Oh,
creating.
the new borrower. Yes. Also, for the new borrower, they will pay their payment. Yes, sir. Yes. Okay.
And then do they pay your service? Do you have the note? Do you have the new note that you're to create serviced by a licensed servicer? Or are you going to service yourself or what?
No, I would send it to a licensed servicer.
Okay. And then when you construct that payment, are you going to encourage or force that borrower to pay servicing fees for you?
That is correct.
Okay. So borrow pay, which is great, right? Let's start the payment as, we can flip this around. So what would be the first month payment you want to start with? We'll say it was last month. Okay? And the original balance of note would be, this actually be
Yeah, you just formulate, yeah.
minus this. Okay? And then what's the interest rate you would create the note at?
12, 13.
Okay. So we'll make it 12.5 just for giggles, right? No balloon, you're not gonna do a balloon. The next due date, let's say it's due for next month. Right? This then tells me that we're good here. It tells me there's 2 months of seasoning on it, right? That's what we do this for. And then the balance of
Okay.
note, which is gonna be hard for you to know. I should grab my amortization schedule in here, but.
You could formula that, or I could whip it on the calculator.
Yeah, if you could put up on the calculator real quick.
Sure.
Sorry.
What was the amortization period?
360.
360.
Well, no, I'm gonna go with 25.
25 years?
Yeah, good man.
Yes.
Oh, 300.
300.
My good lord, can't do math right now. So we're gonna do. I have my calculator here, so we're gonna do.
Unpaid balance. Know when you're ready.
Yeah, go ahead.
All right, 157, $96.08.
157.
09608.
So this is not a second lien, so we don't have to worry about it, right? And then you're not looking for table funding, so we're not worried about that either, right? So we're seeing the fact that this is 78% loan to value. There's 298 payments remaining. The payment per month is $17.14 because of the fact that the borrower was paying servicing fees. 2 months servicing. The net purchase rate is an increase by 2% simply because of one of the factors. Oh, because of this. So
2 months.
Yep, the 2 months. We'll make for giggles, let's make this 3 months, okay? And then what would be the payment on 3 months, Nathan, on that, you know? We can just make it up. I mean, I don't think it really matters now. Let's make it down.
Yeah, it'd be
Not that
close
much, but, right? So we have 3 months, we're okay there, right?
Make it 157 even for the
Yeah, I'm gonna do 3/1/2024.
Yeah.
To get rid of this situation. 156 even.
157.
157, okay.
Yeah.
Okay. So we have an idea. We can guesstimate that we would pay, that's not right.
You can pay that.
Yeah, I know we could, right? I made this morning. Something's crazy with that. Let me see, which one is that? That's that.
I could tell you on my side.
Yeah, go ahead.
Oh, look, the calculator
Yes.
wins again.
Holy goodness, oh my gosh. Let me see. This is
I'll
16.
say
Oh, I know
again,
where.
all things being equal, I'm going to say I would bid it at 13.5% yield. So I would pay roughly 147.
So 142 based on these numbers, right?
Yeah.
If I change this to 13, that's what the problem was.
Yeah, I did
If I
13.
change it to 13, I'm 150 even.
Yeah.
Right. So if I change it to so if this is 13.5, 146,941.
Yeah.
Right. This tells me the fact this is what we're going off here is actually the ITV part and not the actual rate we're looking for.
So then that means for you, Smitty, you've collected 27.5 or sorry, 27,750 for a down payment. You've paid off the underlying 75, and so you get to keep the 27,750 plus whatever the difference is there between the 147 and 75,000.
And the 75, correct.
Yeah.
So it would be
That's pretty good payday.
minus. What was it, Matt? That I'm doing my head here. I got the 27.5 you collected plus what else?
Plus
the
we paid
difference between the 146,911.44 subtract the 75,000.
the HEOs.
146, subtract this.
Yeah,
You got some good lunch money. See there?
that's
101.
not
Yeah.
bad. That's not bad at all.
So the biggest play here is your equity. The fact that you have a $73,000
Yeah, that's
and then
nice.
you created a balance, original balance of, whatever that was.
Now,
And this is a 3-bedroom brick home, 2-bath.
All that doesn't matter to us,
Oh, it
right?
doesn't?
that's great.
Nope.
No, not really.
We make jokes that we don't care what kind of fridge you have, what kind of bed sheets, blinds. You did really nice repairs. We don't care.
Hmm.
Because a 3-bed, 2-bath in that area will have a value of 200,000.
As long as that value checks, then yeah, I don't care. You know,
Oh,
if the
actually,
carpet's new.
that's actually low. It's actually more than that.
All
Right? So if it was a 4-bedroom, that property may go up to 250, right? The bedroom,
Yeah.
bathroom will change your value of your property.
Correct.
That's that. So it's in terms of how many bedrooms and bathrooms, whatever the value is, depending on those parameters. That's fine. So that's a pretty good payday. That's not bad at all. Now the issue then to overcome is Illinois.
Yes.
So is it all Illinois or just Crook County, Illinois? Will you do Will
It's
County,
the whole
DuPage, and Lake?
state.
It's a toughie.
Okay. I just want to be clear. So I do better going across the border to Indiana to do deals with you guys.
Yeah, there are certain note buyers out there who'll buy that, but not many. And those who do may not know about the debt license, and then they get themselves screwed. But no hands off you, right? You don't care. And once you sell it, if they buy it, to me, and my ideas, that's their problem. Technically, you shouldn't sell it to them, but they should be aware of it. Yes, and
Yeah.
most people doing wraps have no clue about debt licenses. I'm amazed that the big players out there, like our Nicks and Marks, out there, don't talk about that enough, because that's a huge thing. People think, well, I just originate. I'm not a debt collector. You originate debt. I mean, whatever you did, you have a debt collector. Do you know
You
a deal we
created
can run
debt.
through here to get an idea?
I got a couple of them. Yeah.
All right.
I got the
Unless
time.
anyone
You
else
got
has
the
a
time.
deal, I know we had some latecomers come
Right.
in. We had about 40 people expected. We have about 9 in the room. So if we have some time to do a few more deals, if anyone has a certain situation. If not,
But again, unfortunately, mine are just pretty much in Illinois at the current time. So it's
yeah, but
almost
you'll
like
get
a
an
waste for
idea
you
of
guys.
what this looks like, right?
Oh, okay. Well, all right.
We're learning from you as much as you're learning from us, and we're trying to
Mhm.
build out a good buy box. It's just difficult. There's so many if-thens that I'm not sure, even though I'm really good with spreadsheets, if we can create it that we say this is the parameter. That's why our goal is this, 75% investment value or our yield. In this case, we're 13.5 for this number here. Each note investor will be different, but it's kind of good rule of thumb for you.
So
Who's
your
doing
yield
that?
is 13.5.
So the yield that he's looking for is 13.5 here.
Yeah. On something like that.
Okay.
And yeah, I mean that would be a deal I would definitely be interested in.
Yep.
Except
Again,
for
if it wasn't in
part.
Illinois.
Yeah.
So let's do another property so we can get an idea. So you can get an idea of, like, you can see the discount, right? And if you want to go off of, percent of UUV, this is what we typically do. I'll divide this by that. And be, whoa, you pay 95%, 93%. Whatever it is. Because this means absolutely nothing to us.
Right. We're looking at
Wow.
yield. That's it. That's what we're looking for. Yield.
And I know
making
Anne's
sure
been
there's
too
enough
common.
equity.
Nick talks about percentage. Percentage doesn't go in my pocket. Yield does.
Yeah.
But yield is only if it's fully amortized and it pays off. No issues, no problems. Then you actually
Yes and
hit
no.
that yield.
If it pays off in 2 years, my yield has went through the roof. Because my maturity is at that time period.
So I'm very
IRR is
happy.
another way of doing it. But yeah, a 2-year paid off in 2 years, my
If
yield.
rates, so you've got this at a 12% interest rate for the borrower. Even now with high interest rates, I'm going to start encouraging them immediately to start looking at banks to get refinanced at a
I see
bank
what you're
at
doing. Yeah, I see what you're
7%.
doing. Yeah. I
and
see
then
what
I'll
you're
get
doing.
paid off in 6
Yeah, you
months,
get paid off. Yeah, yeah.
making a
oh, yeah.
lot more money.
I
So
like
just
these
for-
calls. So now it's like you just put a whole new twist to it. Even though we really want the mailbox money, but if you go ahead and convince them somehow to refinance and pay you off, your yield just exponentially just increased.
Let's just put a wrinkle here. Let's say
Goes
you
through the
charge
roof.
11%. Let's just show you what changes here,
Yeah.
right? Look at the payment chain, the what we buy it
Okay.
for. We flip it back,
Mhm.
146, 132,
Yes.
right? Let's change this number. Let's go back to, let's make this a 360 month. Watch the payment. It changed a little bit, not a lot, but a little bit. Let's go a little
Mhm.
crazy into bar, and this number is changing as we do this, right? 240 months, the 20 year. That goes up, this goes down. So let's go back.
Oh, that went
Hey.
up too.
That went up too.
Mhm.
Oh, you know why? Probably because of ITV.
Oh yeah, probably.
Probably because of this number here.
Yeah.
I can actually figure that out real quick. That's based on yield.
So one of the, because we got a minute here, 25 years for me is ideal because I'm buying in a fund. So I'm looking to have a high enough unpaid balance at the end of my fund, which is 5 years, so that I can then resell that note at a high enough number to pay off what I paid for it in the beginning. So that's why that for me particularly at 25 years is the ideal number. And it's slightly better than 30 and it's slightly better than 20. Actually a little bit more than slightly
Yeah.
better than 20.
Mm-hmm.
So if you made this a 10-year, the payment obviously jumps up, but here we're able to pay more. Not a lot more because ITV kicks in here.
Yeah.
Right. That's why these numbers mean a lot. Right. Now, if this
Yeah, the
was a
payment
third
really
party
didn't
borrower,
jump.
this would change everything. I got an error on that. I gotta see why. I'll see why that does that later.
And you've got access to this kind of product, Smitty?
The software you're playing with right now, your calculator?
No, your
properties.
properties.
Oh yeah, I get them all the time because so there are a lot of individual houses that are free and clear behind in their taxes. So I would just pay the taxes off and give them something, and I'll own the home.
Dude, let's make it rain. Absolutely.
Yeah, but you just said you don't want to do Illinois.
You can Missouri, Tennessee, Texas,
Indiana.
Florida.
Like you say, you're right by Indiana. Slip into Indiana for sure.
Yeah.
Yeah.
And you can do as much deal as you want, and eventually the hard money lender won't be needed anymore because you'll be using your own cash. You'll buy.
Well, that's the other problem that I'm facing. So for instance, I have another property. I just literally got it for $100,000. My balance is 75,000.
Well, let's run these
But
numbers real quick. So property value is what?
I haven't had it appraised, so I'm gonna say rough estimate 225.
Okay.
Mm-hmm.
What do you think you sell for?
I wouldn't, but 225.
That's fine.
Okay. 10%.
15.
15.
Okay. What was your underlying debt on it, you think?
75.
Okay.
See, I have my parameters, my sweet spot.
I hear you.
Yeah.
So I presume is that you basically same scenario with the fact that the lender is the borrower.
Yep, exact same scenario, just different
Okay.
location.
All right.
Okay.
So what would be the original balances? This would be that number and 12 and a half.
Go
For the
with the
interest rate?
13.
13, if you can do it. Just be careful usury laws, right? That's the biggest
Yeah.
thing you have to worry
Yes.
about there.
Mm-hmm. Yes, I have that link to check that out. You sent me that.
Yep.
I saw that.
Yep.
We'll check
And
that.
then the original, this would change a little bit.
Oh yeah, I'm gonna get that formula going.
So idealistically, on this one that we're working on now, I would not want to sell a note on this one because this property brings in literally $4,800 a month.
Yeah.
I have no
To make
water
you sell
bill.
partial on it. Who knows, right?
Well, I would be, I would look into that if you can assist me with that. But more so, I would more look into getting a line of credit because even if I max the line of credit out at the 225, I can build a twin to it, and the payment pays for itself, and I still make some money every month. And I have another building, and I keep doing that. That's my ultimate goal.
Mm-hmm.
So a line of credit is similar to what they call hypothecation. And that's something we won't get involved with. You need
On your side, the hypothecation, that is correct, but I'm just saying taking it to just a traditional Chase or Bank of America or whatever, just to get a line of credit against it so it could work. But
you can do the same thing with a partial. Say I'm going to sell 5 years and do that instead of doing the line of credit if you choose to. But yeah, you can do. If you can go to the bank, that's even better. We're going to say that there's no second lien, that no table funding, 4 months servicing, seasoning, boom. If we have to pay off the wrap, boom, and we're at 153 on this. Again, this is estimated. Nathan's running his own calculator, but it's kind of an idea of where we'd be. But you can kind of get this by example. That makes sense?
Yes, makes sense. But you just mentioned something else that I would like to revisit:
Yeah.
the 5 year instead of doing the hypothecation or taking it to a bank. So how could I structure it? Because then I would want to keep this for myself.
So you can 5 year the payments, 60 months, and then you can literally take out a financial calculator or go online and run a mortgage calculator and put in their numbers, right? So you would put in there something like, I want to solve for the original balance. Right. So you want to solve for this. So what you would say is, okay, what is the term? What's the payment per month? Which would be this number here, right? And then it would be, what's the rate? Buyer's rate. Yield, right? And let's say we still want that same number as we had before. So let's just say it's the same as this number here. So what we'll do here is, say you want 60 months. So I would just do PV rate divided by 12, no more periods, it would be this, comma, payment would be that. So 93,742. And we'd buy 60 months.
Okay.
That one's gonna be a Dave deal. I don't do partials, unfortunately.
You can, but
check
not in the fund.
Yeah.
All right. Well, I would be interested in having a.
Yeah, absolutely. Again, make sure it's not in Illinois, right? Because when you sell that partial, we own the deal for a period of time, and after 60 months, we give it back to you. That's what it really is, and you get it back at a decent balance left in the deal.
So after
That should
5
make
years,
13.
you start collecting that $2,000 again.
Yep,
Correct.
Yeah.
cool deal. Does anyone else have any deals? I see Joshua, Mark, Stephen, David Johnson, Angie. Do you guys have any deals we can run through? We have about 5 more minutes before we've been on for about 2 hours. So
I got another call. I got another call
you
here in
guys
5 minutes.
one or two. I have a property in Dallas I'm trying to get rid of.
let's do some quick numbers here. What is the property value?
The estimate is about 290,000.
Okay. And what'd you sell the property for?
I mean, I haven't sold it yet
What would you sell it for?
About that, yeah.
Okay.
290.
10% down?
Sure.
Okay.
Would you resell it for 225 or 290?
290.
290. Yeah.
You just left it there.
Okay.
Yeah.
Are you wrapping it?
Yes.
Are you the underlying borrower? Or
Yeah,
you-
there's no mortgage. I own it outright.
Okay. Cool. So, uh, okay, and then we'll just say we'll keep these numbers the same. The original, that's good, that's good. What would be your term you'd create with a borrower?
I mean, I don't think I can get 13% over here. Like 9,
Texas,
10%
yeah.
will be
So
pretty
you-
good. Let's say 9.5. Just to be like,
9.5, okay, and then how many months?
I mean, 30-year mortgage. So
Okay.
yeah.
All right, and then let's make this. Oh. 157.
More than that, wouldn't it?
Do we? Oh yeah, it should be. Why is that coming wrong?
Yeah, 290 balance. Yeah, it'd be higher than that.
Rate, door payments, pay amount. So I'm screwing that. 260.
It's gonna be right around 260.
Okay, yeah, I don't know when it's so wow. All right. Yeah, that changed real quick. So either way, all right. So you can see the fact that we have a 191 purchase price with a balance of 260. Why is it so much different? Why are we 73 when we were at 95? Right, there's a reason.
Okay. So because the interest rate is lower, then it's valued a little bit lower at the 73%.
This is your return. Like going to a
Okay.
bank account, you compare two banks, and I'm gonna go to
Yeah.
a bank that gives me a 5% of my savings or 6. You're gonna go to your 6, right?
Yeah.
That's why.
So you're saying shoot for like a 10% at least.
As high as you can go.
10,
High
11,
as you
12,
can.
whatever you can
Or
get
take a
without breaking
discount.
rules.
If you want to sell it, you get it as high as you can because we're gonna take a discount. We're gonna go off that yield.
Okay.
At the
take
same
a
time,
discount.
that's not a bad profit right there.
Yeah, you're
Yeah.
still profiting 220 on it.
By selling the note. Okay. Is this calculator going to be available somewhere?
Yeah,
or-
we're just kind of building it out. We're gonna get next Wednesday when we have our next call on this stuff with some other people. We're gonna go through it. We just fine tuning it so it makes sense for you guys. We've been doing this for over, almost 1.5 decades now. We just want to, we know the note side of it. We're just trying to create it so you guys understand from your side.
Okay.
That's our
Okay.
goal.
Okay.
Right.
And we have your email to like email you like if once I get actually started selling this property on a wrap, and then
Yep. You can reach
I-
out to me or Nathan, and then I actually have a wrap sheet on my website so that we can, if you wrapped it, then this would be a different number. Because you'd be owing money to that original borrower that you're
Right. It'll be a second note instead of first. Yeah. I mean,
not at first second. It'd be the fact that there'd be an underlying debt on the note. You're telling me you own it free and clear, that there
Right.
is no underlying borrower at all.
correct.
You
No
did have an
underlying borrower,
underlying
no
borrower
underlying
when
debt.
this was a wrap note, and the fact that you took it from a third party borrower, Mr. and Mrs. Jones owned it, you took over the debt, and then you're trying to pay off that debt. Say that debt is 250, and you're at 3% on that debt, and you're trying to pay it off. That changed everything.
Yeah.
It won't work.
Right. If I had sub 2 years like that, but I'm not.
Yes,
Right.
sub 2. If you sub 2 with third party borrower, we're calling it.
Okay.
That borrower is not you.
Yeah, I'm doing some of those, but I mean, it seems like that second position note doesn't sell as well, so I'm not trying to do no sales on those.
Yeah.
Yeah.
But I know, Nathan, you have to go. Guys,
I do.
it's been an awesome pleasure.
Yeah.
Feel free to reach back out to us. We'll rerun this thing live on Wednesday. If you want to re-register for that one, that's awesome. I would encourage if you guys can share this webinar, this link with anyone to say, listen, definitely sign up. And just give us props for that, because I think we're just trying to help you guys learn how to sell notes if you choose to, in that position to do it.
We're looking to educate as many people as possible to create good notes so that we can buy them.
Yeah.
That's our whole goal here.
Yep, that's the end goal. And give you more money so you can buy more deals.
Yep.
So, any other questions, concerns? You're welcome. Thank you very much for the comments. I'm
Good
going
for
to
now.
stop the recording. I will stick around for any after question. I know Nathan has to go, but if anyone has any after questions, let me know, and we'll go from there.
Awesome. Thanks, guys. Good talking to you.
When is our next meeting?
We're gonna be holding it next Wednesday. That'll be our next.
There you
All
go.
right, Nathan, take care, bud. You know, if you want to, I'm gonna stop.